I'd like you to meet Dexter the Great Dane to help us talk about taxes in retirement today. So, one of the places that a lot of people have issues, misconceptions, difficulty is understanding how taxes work in retirement. Now, they've been led to believe that it's a big, complicated mess that's really difficult to figure out. Well, here's the truth: taxes in retirement aren't more complicated or harder, they're just different. And why they're different is that you spent your whole working career as a passenger on the tax train. You had one source of income paying you, and the taxes were taken care of. Well, now that you're retired or you're about to retire, you become the conductor on the tax train. You've got potentially multiple sources of income that have to work together to create your ultimate tax bill. This is also why it's possible for two people to have the exact same taxable income but pay very different tax rates. What we'll talk about in the next few minutes here is the three possible tax buckets that you have available in retirement. We'll talk about what it actually means to get pushed into a higher tax bracket and why that's not as detrimental as people think. We're going to talk about how your income actually stacks, how these buckets work together to create your ultimate income and tax bill. And then we're going to talk about where you have control. You are the conductor on that train, and how you can use that control to manage your tax liability from year to year. So let's get started. When you get to retirement, there's three possible tax systems for your money to pass through. The first one, as you see here, is ordinary income. This goes for things like your IRA distributions, your pensions, 401k distributions, potentially taxable Social Security. And this is the bracket that most people are familiar with. It's the 7-tier tax system. So when you say, what tax bracket are you in? This is usually what we're thinking about. And this is the most common bracket for people's income to run through in retirement. Second, we have the capital gains bracket. So this is for long-term capital gains, or what they called qualified dividends. But this is a different tax treatment on dollars that come from maybe you sold some stocks or some assets in your brokerage account, or maybe some other assets that you've owned for longer than a year. Those are subject to the 3-tier tax system of capital gains. And the last bucket that you potentially have money passing through is the tax-free bucket. Now, this would be like Roth accounts. This would be HSAs used for healthcare. It could be maybe you have reverse mortgage income, or you have some income coming from cash value on life insurance policies. There's a few things that will pass through this tax-free Roth bucket. Now, let's briefly touch on this concept of moving into a higher tax bracket. There's a lot of misconception about this, and I hear it all the time. Let's say someone's in the 12% tax bracket, and they take another distribution, and that moves some of their income into the 22% bracket. The misconception is that that now means that all of your income will be taxed at 22% because you're now in that bracket. That's not how it works. Only the income that makes it into that bracket is taxed at that rate. So if you were in the 12% bracket and you spent one more dollar that moved you to 22%, only that dollar is taxed at 22 cents on the dollar. All the money in the 12% bracket is still taxed at 12%. All the money in the 10% bracket is still taxed at 10%. So where most people think it's a catastrophe if they temporarily move into a higher bracket, it's not the end of the world. But just because it's not the end of the world doesn't mean it's not worth paying attention to. Now let's walk through a simple example of how your income stacks in retirement, starting with the standard deduction, or if you itemize, the itemized deductions. Your standard deduction or itemized deduction offsets dollar for dollar the first dollars of ordinary income that you have. So if you had itemized deductions of $40,000, the first $40,000 of your ordinary income is tax-free. So that's the starting point. And then we move into the actual tax brackets. So we'll start by talking about guaranteed income sources. So this might be pensions, it might be annuities, or it could be also your Social Security or the taxable portion of your Social Security. What these do is create a tax floor or a tax base for your retirement. And the reason those create a base is because you don't control the amount and you don't control the timing. Those are coming into your life no matter what for presumably the rest of your life. So you can see that that is not where our control lives. We don't have control over that. That gives us kind of our minimum tax base throughout our retirement. Everything beyond that is where we have control. So I'm just going to pull this up, and you'll see here we have the standard deduction before the tax rates. And then in this case, we have a pension and then the taxable Social Security. Now, IRA distributions are right on top of that. They live in this ordinary income bracket. So you can see in this case, this person has all of their income sources and their IRA distributions move them into about the 22% tax bracket. And remember, only the money in that bracket is taxed at that rate. Just a quick reminder. Now, if you look to the right, you see the long-term capital gains bucket. And what you notice about this person's long-term capital gains is they don't start at the bottom. They actually start where ordinary income leaves off. So this is a key point to understand, is that your taxable income on the ordinary income side fills the first part of your capital gains bucket, and now your capital gains taxes are applied to those gains in whatever bracket they land in. And I should mention that the capital gains bucket is just like the ordinary income bucket in terms of pushing into a higher bracket. Only the dollars that land in that bracket are actually taxable at that rate. Now, when all these sources are stacked together, that creates your total taxable income. But what you notice, and what you've probably understood by now, is that not all of this income is taxed the same way. So where you have your ordinary income covered by the standard deduction, taxed at 0%, then you have your pension, taxable Social Security, and IRA distributions taxed at anywhere from 10 to 22% in this example. And then because of that income, you have your long-term capital gains that are taxed at 15%. You can start to see where in this controllable area above the guaranteed income sources is where you can really start to make an impact. The one thing you don't see here is the tax-free income. And the reason for that is no matter how much tax-free income you have, it does not add to your taxable income, so it doesn't have any considerations relative to these tax brackets. Let's take a look at a basic example that pulls this together a little bit. So here's 3 people. The first 2 have the exact same taxable income, but the one on the left is actually going to pay more in taxes this year. So that's the person we've been talking about. And if you remember, some of their IRA distributions made it to the 22% tax bracket. The only difference between the first person here on the left and the person in the middle is that in the middle, they didn't want to pay 22% on any of their distributions. So they only took their IRA distributions up to the top of the 12% bracket. And beyond that, they dipped into their capital gains bucket. So what happened? The IRA distributions that were taxed at 22% have been replaced by long-term capital gains distributions that are taxed at 15%. So they have the same taxable income, very different tax outcomes. Now, the person on the right, you can see, made a completely different choice. We still have the same tax base. We have the standard deduction, the pension, the Social Security, but instead of taking any distributions from assets that live on those 2 brackets, the ordinary income or the capital gains, they decided to fill the remainder of their required cash flow from their Roth account, their tax-free account. And for them, it's a completely different tax scenario. But for all 3 of these people, their end goal is to have the same amount of money coming into their pocket. So the takeaway here is that that tax base doesn't change. The guaranteed income sources, that's not where our control lives. Our control lives in the combination of withdrawals we make from the other types of accounts that we've got. Now, this video is not meant to be tax advice. I'm not a CPA, If you're working on this on your own situation, please talk to a qualified professional before making any decisions. However, it is meant to be educational so that hopefully you have a little better understanding of what goes into determining that ultimate tax rate in retirement. And I hope it's encouraging that you have control. But the main takeaway I want you to see is that you might be sitting there and saying, I don't have all those buckets. I have all my money in a pre-tax account. Well, that in itself is an opportunity. One of the best things you may be able to do in planning before retirement is to start to, or even after retirement, is to start to build those other two buckets so you have the most flexibility and the most choice when it comes to your retirement income. The last thing I'll say is that tax planning isn't always about paying the least amount this year. This is a long-term proposition, and understanding the long-term tax consequences of your short-term decisions is really important. However, this is a good start. So from me and Dexter, have a great day. Thanks for watching.